way. So you've stood out, and we're eager to hear from you. There's really four things we're looking for, right? Looking for the right person, the right idea, in the right market, and the right business model. So my friend, please take it away. If you want to share your screen, please do so. If you just want to speak, the stage is yours. You got 5 minutes. We might get another minute. We see that you're wrapping it up, and we got no questions. Please take it away.
5 minutes should be good. So I'm going to do both. I'm going to share my screen and I'm going to speak. So get the best of both worlds. Let me know.
Real estate investment is perhaps the biggest investment that you will make in your entire life, if you ever get the opportunity to do so. But when you're playing this space of real estate investment, there's a number of things that you need to know to be able to play the game and play it well. Today, we'll be talking to you about real estate investment, and there's 3 important things that I want you to keep at the front and center of your mind. 1, I want you to think about cash flow, and we will talk about cash flow. 2, I want you to think about asset appreciation, and today we will talk about asset appreciation. And last but not least, we will talk about equity leverage. So if you have your pen and paper, I want you to write these 3 things down: cash flow, asset appreciation, and equity leverage. Now, in the event that you're joining me for the first time, my name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Billionaire Codes and Manager's Toolkit. I'm also the author for 10X Branding and Marketing Blueprint, The Psychology of Doing Business. And again, you don't want to miss this book, because this book really introduced you to a number of key concepts that really helps you to build out your brand to make larger than life impact on the specific target market, on your workforce, on the general public, and on the cash flow potential of the organization. Along with this, you will be introduced to what is known as the 5 ecosystems of successful business. Along with this, you will learn about the system value proposition 101. Very new concepts. And of course, we have also studied the top 100 companies in the world, and some of those systems that they're using, we have introduced this into this book, 10X Branding and Marketing Blueprint, The Psychology of Doing Business. And our vision is that if you learn them, you apply them, you master them, you incorporate them into your business to ensure that you can 10X your business, your ideas, and your brand. All right, again, if you're in business or you intend to get into business and you're viewing this program for the first time and you never press that subscription button, I want to encourage you to press the subscription, press that notification bell, press like. So you will be the first to get these programs that we bring in, and I am bringing to you on a regular basis. And this program comes to you with the kind compliments of Global Capital Inc. and 10X Branding and Marketing LLC out of New York. Now we have a team of persons there who are committed to working with you and providing you with the best advice to ensure that you are growing and you are scaling with local, regional, and international relevance. Now let's start our conversation today. Today we are talking about real estate investment. What comes to mind when you hear this term, real estate investment? Of course, we are talking about land acquisition, and we are talking about income generating assets. Now, one of the things that we are seeing, and this happens very often across the world, we see that many persons attempt to acquire their home. And you tend to believe that your home is an asset. The home that you purchase, the home that you live in, you tend to believe very often that that home is an asset. And you're not able to distinguish between the difference between real estate as good debt and real estate as bad debt. So in most cases, when you go to buy that first home, you make a bad investment decision. And just let me say to you, give you a few examples why it is considered to be bad. And we are looking at investing in real estate in terms of it being a bad debt, and investing in real estate in terms of it being a good debt. Now, this is what happens in most cases. You save up a sum of money because, of course, the financial institutions will ask you to get some equity in the game, get some skin in the game. They may ask you to put 10% in that investment portfolio. And along with that 10%, the bank now will fund the additional 90% to ensure that you can acquire that home. But guess what? For the next 15, 20 to 30 years, if you do not take out a second loan or refinance that debt, you're going to be saddled with that debt, and you're going to be paying for that home from your primary source of income, which again might be your single source of income. You start to recognize that it is a bad debt when in a global pandemic you lose your job and you're not able to pay down, or you're not able to reach your monthly collateralized, amortized debt obligation. Then, perhaps and only then, most people then recognize it's a bad debt because they now stand a chance of losing their first home, their dream home. Why? Because it's a bad debt because you have to dig into your primary income source to pay for that debt. Now, there's a major difference between taking a debt and leveraging that debt as a good debt and leveraging that debt as a bad debt. When you take out a debt and you have to pay for that debt, you have monthly obligation, debt obligation, interest rates to pay for that debt on a monthly basis, and you're taking that, you're paying for that debt from your primary source of income, it is considered a bad debt. Now, what is this good debt? A good debt is when you take a debt, and before you take that debt, you identify how to create positive income cash flow, how to take that debt and ensure that you're investing that debt back into income generating asset, income performing asset. All right. And of course, there are a number of income performing assets. Real estate is only one of them. You know, there is Airbnb, there is buying a fleet of cars and renting those cars out, to, building partnership with Airbnb. There's a range of different things you can do to ensure that you're creating positive income cash flow, or you're investing in income performing asset. All right. So I trust that you can make the comparative analysis here between good debt and bad debt. The good debt is when you're able to take that debt, you're able to up-level that debt, you're able to cash flow that debt above and beyond your monthly debt obligation. So these are important things for you to stop, take stock of, and ensure that you can make a the right decision when you're going to invest in real estate. Why? Because every year we have hundreds and thousands of persons because you're playing a game that you do not fully understand. And when you get into the trouble and you get that foreclosure letter, then you start to scream. Very often we have to interface with persons who are faced with this. And now we have to help them to navigate that process. The smart thing to do is to think about these things before it happens, think through the process, and ensure that you have all of the safety nets in place. Now, if you don't know how to do this, it's advisable that you get your PFA, your professional financial advisor, or your personal financial advisor to guide you and mentor you and coach you through this entire process. So when you make that investment in your home, you want to know that it's going to be there for life, it's going to cash flow, it's going to give you appreciation, either natural or forced appreciation, and we'll talk about that. And it's also giving you equity leverage. All right. It's the biggest investment perhaps that you will make in your life. And if you know what you're doing, it can be the smartest investment that you can make to build wealth. All right. So positive investing in real estate and allowing it to positive cash flow can be done at the simplest of level, or you can invest in real estate as a multiple stream of income. And that's where, for example, instead of just buying the asset and creating a single rental or a double rental, you buy that asset called real estate and you create multiple units for either office rental, creating office space, or for living quarters, family units. There are different things in which we can do in this particular path, and it's important that you think through this before you go into it. However, this is not financial advice. If you want that, I want to encourage you to reach out to us, and we will have our professional interface with you and give you a step-by-step guidance, all right, a toolkit to navigate this entire process. And as you think about taking a debt and up-leveling that debt into becoming good debt, performing assets, there's a couple of things that I want you to also keep at the back of your mind. One, you must understand what is positive income cash flow. You must understand expenditure, because to cash flow that asset, in most cases, you will have some expenses and you need to understand what is that. You need to measure your balance sheet, which this is your income against your expenditure, which gives you your balance sheet. But there are other things for you to think about, things like your ARR, which is your annual rate of return, And your annual rate of return simply represents the equity that you would have put into buying your first building. Once you start to think of how to leverage it and how to cash flow it, you're also thinking how to take out back that equity that you would have put in. And we analyze over what period of time, over how many years you're able to, one, and pull out back that investment and gain on the investment. Like, for example, there's something that we call the ARR, the annual rate of return, and another ARR, the annual recurring revenue. And those are two things that you want to keep in mind. Now, the annual rate of return, as you're able to extract your deposit that you put in to start the business in the first place, become your annual recurring revenue, because you have now taken back that investment and you own the asset, is performing for you. Those are some technical things that we will get into over a period of time. There's also what we call the ROI, return on the total investment. So these are some technical terms that over a period of time, we will get into this with you to really help you to understand this, so as to ensure that you're making the best and smartest decision when it comes to investing in real estate. So far we have talked about the first area of real estate investment, and we say that there's good debt, there's bad debt. There is invest in real estate as a single unit, so you have a small cash flow, or you could invest in real estate and create multiple income streams. And all of that will influence your annual rate of return and how fast you can actually get to your annual recurring revenue. All right. Now, I want us to take a little look at what is going to be called now the asset appreciation. Now, land and estate is an asset that gives you tremendous appreciation. And this is one of the reasons most people will say that owning the land is much better than putting your money into a savings account and just getting a 0.1% interest rate per month. Why? Because inflation is taking place, and every dollar in that bank account, whenever inflation takes place, the value of that fiat reduces. Now, what happened with land and real estate, it's totally different. You get asset appreciation. And how does one get asset appreciation? You get asset appreciation because of inflationary factors. Labor cost goes up, material cost goes up. And every time those market realities strike and hits, you get appreciation that is taking place. Now, it is important that we should also talk about the two types of appreciation. There is natural appreciation and there is forced appreciation. And let's look a little bit at some of these. Getting into the game of real estate, it's important for you to know this, because you can buy land and build your estate in all of the wrong places where it is difficult to cash flow because you did not do the due diligence, you did not do the market analysis, you didn't understand your target market, their needs and their wants or their expectations. You didn't look into the things that is going to promote and encourage them to come to particular areas to invest with you, to rent your property. So some of the things that you need to look at is things like safety and security. Whenever you're going to buy land, it's important to think about safety and security. This too can have a natural impact on appreciation, because safety and security can cause the community, the area that you're in, to be come into high demand. All right, public has pleasant opinions about the area, so demand to come into that area, it becomes higher and higher. The more demand increases, the cost can go up, and the cost for rental in those areas or sale of asset in those areas, real estate asset, can go up. So these are some things that you want to be certain that you're thinking about. Some other things that can cause appreciation to take place is, let us suppose that a new supermarket comes out, a new recreational park, a new play park, uh, a, a unique educational platform comes out within those particular communities that makes the area more desirable. All right. Family wants to get their children to that school, and they want to be within close proximity of the school. So they want to either rent assets there, property there, or buy assets there where they're close in proximity. So there's so much to think about when you getting into the space of real estate, and to ensure that you're making the best and informed decision in this particular space. So we have looked a little bit at what we call natural appreciation, but there's also what is known as the forced appreciation. And forced appreciation can be that you buy a piece of real estate and it has some fixer-upper to do. And you do those fixer-upper. You might put on an attractive storefront, an office front that makes the building more appealing. That is what we call forced appreciation. You might invest some monies into the ambience and aesthetics to enhance the feel and look, of that entire space. That is also forced appreciation. You can also add additional rental units to the existing apartment building. That is also forced appreciation. The value of that asset is going up all the time. So you have both natural and you have forced appreciation that is taking place here. And believe me, there's perhaps nothing in the world that can cash flow the way real estate can cash flow when you really take time to understand it. And you can get some skin in the game and you can do it the right way. All right. So far I've given you two. We have discussed two headings. We have discussed real estate as a cash flowing machine, and we have discussed real estate as it relates to asset appreciation. Now, let's look a little bit at the third tier of this subject matter. Real estate also gives you equity leverage. Now, as the asset appreciates annually, and the appreciation simply means that the value is going up. So let's take, for example, you purchase a building for $100 million and it appreciates 10%. It simply means that the equity now is $10 million. So you can have equity leverage. Now, it might appreciate more depending on the area that you're in, it depending on the period and all of those different factors. Over a period of time, you can have 50% of appreciation, 60% appreciation, 100% appreciation. And all of that gives you equity leverage. Now, depending on which part of the world you're at, you can take out the equity and you can invest that equity however you want to. In the developed world, you can take out those equity and you can invest it back into other forms of real estate. In developing and middle income economy, I am seeing that there's some restriction in terms of that. And I believe that there should be a strong cry, a loud voice, strong advocacy against anything that is going to limit people's potential to build wealth. This is an honest approach to building wealth, and of course, the whole world should be behind people that wants to build wealth in the most honest way. So these are important things to look at. Now, when you take out that equity in terms of your home, we call it a HELOC, a home equity line of credit. And it's important for you to take the time to understand what is being said here, because a home equity line of credit is different from a home mortgage. And what are the major differences here? A home mortgage may be compounded interest. And what compounded interest means? Now, if you have a mortgage, you have a book, and you check, let us suppose that you borrow $10 million today, and you're borrowing at 10%. You look at your total debt from the very first day that you borrow, you will see that it's not $10 million, but the interest is added on to that, which is going to bring it back now to about $11 million. And in most cases, the equity that you put in up front may be canceled out as the interest. So depending if that is done or not, you may just see the principal balance in that account. Now, that is what we call compounded interest. It is added on at the first day of the year for the entire year. And there's no flexing in relation to that. It's an interest added on, and there's no flexibility in relation to that. That's an agreement that you're signing on to. The HELOC is different from the perspective. The HELOC is calculated on simple interest, meaning that it has a reducing balance. So every time you pay down on that equity loan, the HELOC, the principal balance comes down, and interest is only calculated on the outstanding balance. And that's a major difference. So what that does, it gives you a fair degree, greater level of playing field. It gives you, it helps to save on the investment portfolio itself and so much more. So it's important to take the time to understand the difference between a home mortgage, which is compounded, collateralized, amortized, compounded, and a HELOC, which is the home equity. It's calculated on simple interest. The same principle applies to the BELA, the business equity line of credit. At least it should be. The same principles should apply in terms of the simple interest credit. So these are important concepts to know. Now let me just go a little bit deeper here. You can take out the equity from an asset that is already a performing asset, and that equity can go and buy another asset and pay cash for it. Because let us suppose that you have an asset, $100 million, you allow a few years to pass, and perhaps you have natural appreciation taking place. It jumped up 100% or 100%, 150% in terms of its equity appreciation. You can take out that entire sum and put it back into purchasing another asset, a performing asset, and cash flow that thing. Some may say in the Caribbean, you cash cow the whole thing. You make it a cash cow. You can do that. In the developed world, you're able to do this. There are a lot of things that are still to develop in the developing economies and middle income economies, so as to create that level playing field for persons to honestly build wealth. So these are important concepts for you to know and ensure that you are applying these systems in your life as you take steps to build wealth. You can take the equity, you can up-level the equity, buy an asset, with absolutely no debt on it and still use that existing performing asset to pay off that equity cost that you're taking. Or once that other asset is cash flowing, you use the cash flow, the positive cash flow from that asset to put back into that pay down on that HELOC, that home equity line of credit, or that business equity line of credit. Now, don't get me wrong, I must say this. I'm not telling you don't go and buy your home. I'm simply saying to you, there's a smart way and there's a wrong way in which you buy your home. Most of you buy your home and you buy it as a liability. You want to buy it as an asset. And if you don't know how, I want to encourage you to reach out to our office at Global Capital Inc. and 10X Branding Marketing LLC, and we will be happy to share this information with you. All right, so you want to invest, take equity and invest in a income producing asset. So I trust that you learned from today's podcast. Today we talk about real estate investment, and we look at the three important concepts to think about or to know when you get into real estate. That is to see real estate in terms of its potential to cash flow, to see real estate in terms of its potential to give you asset appreciation, and to see real estate in terms of its ability to give you equity leverage. All right. So over time, I'll give you more of this information to help you to understand smart, creative, innovative approaches that you can use to build wealth. The wealthiest people in the world, they're using these techniques, and I believe that you can use them too. And if you don't know how, again, like, subscribe, share, so you will get these information that we are bringing to you on a regular basis, and you know exactly what to do moving forward to build wealth the honest way. Be blessed and see you in the next broadcast. But just before you go, in the event that you're joining me for the first time, my name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author of several books, including Billionaire Codes and Manager's Toolkit. I'm also the author of 10X Branding and Marketing Blueprint, the psychology of doing business. You don't want to miss this book. So like, subscribe, and share. So you will be the first to get this information that we bring to you on a regular basis. Be blessed, take care of yourself. See you on the other side.